Hello viewers, welcome back to our YouTube channel, KC Accountants Education Center. And today we are looking at the cost of capital, and we want to get straight away, we want to look at some of the reference questions or trial numbers. I'm beginning with trial numbers on most of these topics because I want you to get it from the beginning that these numbers are examinable. So we can have maybe November 2019, question 5, part B, August 2018, question 2, November 2019, question 3. So all of it was all about cost of capital. So we want to understand what cost of capital is and how we can be able to go through the different aspects of cost of capital. This is just an introduction. So cost of capital is an important area that we need to be very careful with. But no one will ask you about the definition of cost of capital. But the definition could be from either two viewpoints, depending on whether you are an investor. If you want to determine, to get the real definition, you should have it from the two standing point. Either you are an investor or you want to borrow. You are a borrower. If you are not an investor, then you are going to be a borrower. That's when you can be able to get the different versions from the different viewpoints of whether you are an investor or you are a person who is borrowing money. So if you are a finance manager, meaning you are going to be from the view of the borrower, that is from the view of raising money. So you are going to be with the view of acquisition of finance, of funds. So it's going to be, so if you are acquiring loan, then acquiring fund, then it's going to be the borrowing rate. How much are you going to pay for the money, or they are giving you that? What is the cost of that loan that you are getting? For example, if you go to the bank and you want, let's say 1 billion, and this 1 billion, maybe you are going to do some investments. So this money is not going to be for free. You take this 1 billion, but it's not going to be for free. It's only going to be free if you get it from Islamic finance. Remember, we talked about Islamic finance earlier. But also we know that Islamic finance is not that free, but it's a bit relative compared to the borrowing aspect. So even if you get it from your shareholders, of course, shareholders, there you are looking at it as an investor. But if you are the finance manager and you are just acquiring funds, then you can go in for borrowing, or you can raise shares, issue shares to the public, so that you can be able to get more cash. So if you borrow from the stock exchange, then the investors, for the investors, we are going to look at it. For the investors, we are going to look at it as a return on their investment, If they give this 1 billion and you've gotten from shares, issuing shares to the stock exchange, then the rate of return you are going to be paying these investors is what we call the cost of that fund that you've got. So the investors, they also want a return on the money you have got after buying the shares from the financial markets. For example, if you are the finance manager and you may be required to evaluate yourself the investment that you are going to make, because if let's say you have borrowed you have a borrowing rate of, let's say, 10%, and you are used both debt, maybe debt is 10%, and you have also got equity of, let's say also 10%. That is the dividend that you are going to be paying. So what is going to happen is that all these people, these ones, they want their returns, even though you are the one to determine when you are supposed to pay them, but they want it. Even these guys, they want it. So this is 10%, and this one is what we call, is also, this is cost of equity, the cost of equity. Then this one is going to be the cost of debt. Cost of debt. So what is going to happen is that for you to get the cost of capital, the overall for the company, if you add this and this, if maybe we don't have tax, we don't have anything, you get your 20%. So this 20% is going to be what we call the cost of capital. The cost of capital is 20%. So you must make sure that where you are investing this money, it is able, that business is able to generate more than 20%, so that you can pay off the debt holders and then the equity holders, and you remain with something. So if you evaluate your projects and you find maybe you have gotten maybe the percentage as that, maybe you are using ARR, accounting rate of return, ARR, and maybe it is 25, just know the 5% is now going to be what you are going to remain with, because the 10% will go to the debt, and then equity will take also the 10. So that's just a rough analysis, but financially it's not how, like, if you know what you're doing, then you shall find ways, because there are other things that come in, like the tax, like, and others, as we shall be seeing, that we shall come to adjust from that cost of capital. But that's what briefly I can talk about as far as the cost of capital is concerned. It's that minimum rate that is expected from the funds that you have used in your capital structure. So let's now look at the relevances. What are the relevances? They call them relevances, significances, or importances. So you can even call them objectives or relevances. It depends. Relevances or significances or importances of the cost of capital. In investment management or investment decision. Cost of capital in investment decision. So if the examiner doesn't use the word relevance, let me write them. If the examiner doesn't use the word relevance, the examiner can use the word significance, or you can use the word importance. Importance of cost of capital. So those are some of the words the examiner may use. The importance of cost of capital in the capital structure, in your capital structure. And we say the capital structure is just a mixture of funds that are used to finance the business. So we say the capital structure is just a mixture of funds that are used in a given company. I hope we are getting the arguments. So let's now look at some of the points. Number one, we can talk about investment evaluation or investment appraisal. We can use the cost of capital is used to evaluate a project. That's the point. So you, as a finance manager, you are responsible for identifying and evaluating. Of course, you identify and evaluate the relevant projects that the company must undertake to invest in. You look at the kind of businesses. Remember, as I told you at the beginning, that you should look for that business that is going to help you earn more than the cost of the capital that you received. If the cost of capital is 20%, then you should take up that investment decision that is going to give you maybe a rate of, let's say, 30%, so that the 10% can actually be a profit from that mathematical point of view, so that you can be able to see that you are making progress. So since there are very many projects that you want to evaluate or that you want to invest in, you must evaluate all those investment ideas or investment projects and choose the best alternative to invest in using the cost of capital or using that discount rate. So we evaluate this using that cost of capital, but it is through the different methods, either using the discounted cash flow techniques or the non-discounted cash flow techniques. But the bottom line is to evaluate the investment ideas and you come up with the best alternative is where you should invest your money. And the best alternative is that is going to give you more than what you have put in the business. So we use those different tools. We can use the non-discounted cash flow techniques or we use the discounted cash flow techniques. And most of the times, the examiner will tell you to evaluate the project using any given discounted, either discounted or non-discounted cash flow technique. But most of the times we always go for NPV, net present value, because NPV is a bit broader. It involves in identifying the different cash flows. You don't just discount the cash flows. You have to first look for the discount, the cash flows that you are going to discount. So unless otherwise, the NPV is more preferred. But I'm not saying that it is the one that you will always be examined on. Others, we are going to look at all of them as we are doing what we call the local NPV, and then even when you are doing the international NPV. They are a bit different. The NPV of a local company is different from the NPV of an international company, and we shall understand those ones when we go to those ideas, those investment decisions. So, but you know that for you to compute NPV, you know that you will need what we call the discount factor, because you will need to discount the cash flows that the project is going to generate, and you make them present so that you can determine whether the project is viable or not viable. And that discount factor that we always use is what we call the cost of capital. It's the one that we use to discount the cash flows to make them present. And that's how the cost of capital is used in investment appraisal or capital budgeting decision. Let's look at point number 2, designing debt policy. Now, if you have computed your cost of capital, you learn that this cost of capital, we call it, we always refer to the WACC, the weighted average cost of capital, because it is the overall. If we don't call it WACC, we call it overall cost of capital, or we call it the weighted average cost of capital, or just cost of capital, or what we call the desired rate or the minimum rate. So it has very many names, but just know the bottom line is the fact that we use it for designing the debt policy. Now, when you have computed your cost of capital, when you are using any given capital structure that you have in the question, including both the debt finance and then the equity finance. So when you combine the costs of debt and then the cost of equity, all combined together, they will form what we call the weighted average cost of capital, or what we call the WACC. So if you have discovered that your cost of capital or your weighted average cost of capital is, let's say, 10%, and you have computed and you've gotten 10%, and you are designing your debt policy, then it could be in one way, debt policy, the debt policy in terms of the money you borrow, or it could be in terms of the services you give out on credit to people. Then you may say that you may not be able to give services to people at a price that is less than the desired or the calculated cost of capital. So if let's say you are saying that this is my rate, 10%, so it will help you to design when you are giving out debt to people, and also when you are acquiring more debt, because you shouldn't expect that your weighted average cost of capital is 10% and you expect someone to give you a loan where you are going to be paying interest of, let's say, 20%. This one doesn't make sense. Or whereby for you are giving out credit 20%, 30%. So it helps you to design the mechanisms that you can use as a business. So the other that we can look at, we can use it for formulation of debt, formulation of dividend policy. You can use it to know which percentage should I give out in terms of dividends to my shareholders. So as a finance manager, you are responsible to pay dividends to your shareholders or the owners of the business. So you will use this cost of capital to determine how much to pay these shareholders, because it's going to be the cost that you will use to benchmark to know how much does it cost you to get more funding from different sources. Because if you don't base on this, if my work or the cost of capital is 10%, at least when I'm giving out dividends, at least I shouldn't exceed 10%. Reason being, if I exceed, then it is going to cost me much more money for me to raise more capital. At least I rather give them 10% of my retained earnings or the profit after tax. Then I remain with the balance as retained earnings that I can use to invest in the business to make more money. But if you give out more than, because this will be the original cost that can guide you, that for you to raise the money you've used in the business, you spent 10%. You are paying out 10%. So even when you're distributing, you can say, let me use this as a benchmark for me to set my dividend policy. Because after all, the money that is going to be paid out in terms of dividends is determined by the management. Of course, the CFO, the finance manager, is going to be the one that is advising these other people on what to do, depending on the pending investment ideas. Because you can be having a project of, let's say, 2 billion, but you made profit after tax of, let's say, 500 million. And for you want to give out all the 500 million, yet you have a project of 2 billion that you want to accomplish. So you can say that since I have already 500 million, I can keep this 500 million. Maybe I just increase the other guy's shares. They just increase, they get just paper dividend, but not the real money, so that you can use the same money and maybe you top up the 1.5 billion that is pending to make the 2 billion for that new investment. So the other, you can look at it as a measure for evaluating performance. So you can look at the profits the managers have made. Have they made enough money that can be able to pay off the debt holders, the equity holders, and also remain with something? So if they have not done so, then it means you can regulate, you can benchmark on what they have done in terms of evaluating their performance. So that's what I wanted to look at in this video. In the next video, we are going to basically focus on what we call gearing. We want to look at gearing and the cost of capital. When these two are combined, what is the impact? Cost of capital. So want to understand how gearing or a company having more debt, what is the impact of the company having more debt onto the whole overall cost of capital of the business? What is the implication? That's what we are going to look at in the next video. So thank you for watching. Let's meet in the next video as we are looking at the gearing and the costing of capital. We'll see you there.